Hey everyone, me Kevin here. This is a message to all investors. In my opinion, what going forward we should be thinking about to make sure we can maximize our wealth going into 2023. So rather than a financial news update in terms of what's going on today, I believe the information in this video will be quite useful for you for many months in the future. Now, keep in mind, even though I am a licensed financial advisor, I cannot give you personalized financial advice, so we'll call it generic financial advice. Okay, let's get started. So the first thing that I would consider right now, where we are at the end of 2022, is there is a lot of fear and uncertainty and doubt in markets. And the very first question you have to ask yourself is, do you have the faith that our economic structures will be stronger and better for the rest of the decade than they are here in 2022. Now, of course, there's the possibility that things may get worse before they get better, and I think people are 50-50 on that, and that's okay. But I would say probably 90% of us watching agree that, well, things will probably end up working out okay. So we have to position ourselves in such a way that we get to be a part of the rebound. And I think that's the most important thing for us to think about right now is not, what's our net worth today compared to last year? Rather, what can we do today with whatever we have, or whatever's left, and make the best of it so that when that next upswing comes, you're on the right side of that upswing. Think about this. Let's say you had a really high net worth in 2006, and all of a sudden you're in 2009 going, well, damn, this sucks. The worst thing you could have done would have been to give up, to stop working hard, to get out of markets, and sit on the sidelines, because you would have missed the run from 2009 to potentially 2021. In fact, when I started making YouTube videos, well, I made my first videos back in 2010 and 11 and some throughout 13, 14, 15. But when I really started more full-time working YouTube was around 2017, 18, 19. And boy, oh boy, every day there were folks complaining about how terrible things were in the economy and how investing is horrible. And of course, some of the best investment returns ever were made after that. 2019 towards the end, 2020, 2021, the entire bull market that we've had essentially since 2009. And really, the fact was, investing in America was always the best choice. And not trying to trade America, but investing in America for the long term was the best choice, whether that was through real estate or through stocks or whatever investment you're making into yourself. And so I think as investors, one of the first things that we want to think about as we get towards the end of the year here is, okay, practically, how can we prepare? What should we potentially consider doing next? So one of the first things that frequently is done in the November-December season is we start thinking about minimizing our taxes for 2023. And one of the things that I really want to caution against is the desire to spend a lot of money on equipment or expansion towards the end of this year, where you're going to be hooking yourself into substantial monthly payments for 2023. I think you want to go into 2023 with as little overhead as possible. Let me give you a few examples. So sometimes what people do towards the end of the year is they spend a lot of money on solar systems for their home, and they calculate a 7-year break even. Well, you do that, you're potentially tying up a lot of capital towards the end of this year where markets may be close to their bottom for the sake of a 7-year break even. And if you figure we might be on a more upside trajectory sooner rather than later, you might want to have more of that liquid available for other purposes. So I'm not a big fan of, at this point in the cycle, making big investments into your home. I think some of the worst investments you can make right now are into your home. A new kitchen, a bathroom remodel, batteries for your home, solar panels. Now's not the time for that. Wait for the tax credits to come out over the next few years, and wait for some of these companies to start begging for customers rather than us begging for them. You look at Generac, Enphase, people are begging them to get these products right now. Now's not the time to do that. You look at another tax deduction people like to do towards the end of the year, especially businesses, is they like to buy boats, planes, and cars, especially cars over 6,000 pounds, planes up to any amount of money, and although that's really going to appeal to a very small percentage of people, and boats up to a $500,000 deduction in general. When you look at that, it's like, whoa, wait a minute. Those are some big deductions I could get. I mean, you could write off 100% of a plane on your federal taxes. You spend $10 million on a plane, you could offset, you could basically save $4 million in federal income taxes. It's insane. I mean, obviously talk to a CPA about all this stuff. But what you do when you hook yourself into these big expenses, cars, boats, planes, is you're setting yourself up for a big load of debt in 2023. So you're going to get a nice tax benefit, but now you're setting up yourself for debt that you're going to carry into 23, 4, 5, 6, and what happens then? Well, now your debt to income ratios are skewed, and it's harder to get into real estate in the future. It's harder to finance things that are actually going to make you money in the future rather than what we call butter purchases. Now, people regularly like to justify butter purchases because of the tax write-offs, but you have to be very, very careful because those tax write-offs help you for 1 year, even though you might be signing up for 7, 10, 15, 30 years of debt. So you have to be very careful with that. Now, so I'm not the biggest fan of spending a lot of money at the end of this year, because I think this is more of the time where we want to be thinking about positioning ourselves income-wise and business-wise and investment-wise. So what do I mean by that? Okay, so if you are employed or you're a self-employed entrepreneur, my opinion is you want to be in a situation now where the first thing you do is you solidify your primary source of income. You might not be able to do that. You could be in a business where your income is uncertain. For example, I don't know what YouTube is going to pay in YouTube ad revenue next year, so I have to be even more careful with decisions like hiring and spending and monthly payments because I can't be certain what my income will be in the years in the future. That's different if you have a salary, though if you have a salary, you have the risk of potentially getting fired. So you've got to evaluate, okay, what happens if my income suddenly plummets? You don't want to be stuck, drowning in debt up to your eyeballs, because now it's going to be very, very difficult for you to actually be a winner on the upcycle, right? And we want to be winners on the upcycle. So, securing your income, securing your number one primary source of income is probably the most important thing to consider now. And ask yourself, how can you increase that form of income? If you are someone who is a salary, one thing that you could consider doing is starting a side hustle. This is actually something we talk a lot about in the Elite Hustlers course, which comes out on Black Friday. Of course, all of the programs on Building Your Wealth, link down below, are having a 60% off sale for Black Friday. This is the best pricing you're going to get. The pricing will never be lower. And we're adding a bunch of new lectures. Not only is the Elite Hustlers course coming out on Black Friday, but the existing courses are also getting free updates. So if you're already a member, you'll get the benefit of that always increasing book of content. But we have to think, if you are on a salary, something you might consider actually doing is starting a side hustle that is actually going to produce income for you. You don't have to spend a lot of money on a side hustle. A lot of people, the first thing they do when they think side hustle is they think, oh, okay, I need to go out there and I need to start spending money on attorneys, and I need to get CPAs and LLCs going, and I got to do all this crazy stuff. Look, when you start a side hustle, you go to Hiscox, you get some insurance, stop worrying so much about the liability, do the right thing, but focus on making money. When you focus on making money, and actually increasing your income on the side, now you can also take advantage of tax benefits that might only be applicable to entrepreneurs rather than someone who's salaried, right? You'll be able to offset some of your expenses for things like whether it's phones, whether it's computers, or whatever. You can take many more tax benefits as an entrepreneur than as you can if you're on a salary. So consider that. That doesn't mean you want to lose your primary source of income. In fact, the most important thing you want to do is strengthen that number one source of income. Remember that a lot of folks, when they get excited about something new, like a side hustle, they forget that, wait a minute, my first income is paying me, let's say, $8,000 a month, but I really love my side hustle. It pays me $500 a month. Yeah. But how much harder is it for you to go from $500 a month from your side hustle to $2,000 a month, which is an extra $1,500, then how much harder would it be to go from $8,000 to maybe $10,000 or $11,000 of income, right? usually it's easier to increase that first line of income. And I'm a big fan of focusing on increasing that top line of income. And one of the things to remember is many jobs will pay you, oh, it's loud over here. Many jobs will pay you over 6 figures if you just have a license that nobody else is willing, capable, or able to get. Think about it. You go get a Series 65 license, you could immediately start working for a registered investment advisor and you'll get educated by them, right? But you start learning how to sell investment products and managing other people's money. Of course, you'll work under somebody else, like you're working for a broker, like a real estate agent. If you get yourself not only a Series 65 license, but you become a CFA, all of a sudden now you're next level on finance or Wall Street. But that's not even so necessary. I mean, there are people who become, they go to nursing school for a couple years and they get into anesthesiology. And these nursing anesthesiologists, they start out at $200K a year and then they're going to $300-400K. So personally, I always think now's the time where you want to be thinking to yourself, wow, how can I expand my income now? And in these dark times, how can I increase my value to my employee or employer or to myself? And I think oftentimes we forget that it's not just about asking for more money, it's about providing more value to your boss or to your own company and having more certifications or licenses to justify more income. So that's something I would consider. Next, I believe as an investor, once you've secured your income, you've lowered your expenses. You're not going crazy with trying to spend money on assets that are depreciating assets, butter as we call them, things that melt away over time. Once you get away from that, you really want to be thinking, in my opinion, of investing where it makes sense for you. If you're an older individual, that might be investing in treasury bonds. Take the guaranteed 4.5% you can get right now on some of these treasury bonds, ladder a portfolio. It's very simple to do. Go to treasurydirect.gov and you can learn a lot about investing in treasuries and getting a risk-free return. You could lock in a 10-year bond that consistently pays you 3.75% right now. It's absolutely remarkable. And the cool thing is, you don't even have to worry about market risk if you're willing to hold those bonds to duration, which just means until the bond is done, right? Then you get fully paid out. It's really incredible. So I'm a big fan of, if you're looking for some kind of passive income right now that's secured and you don't want to be subject to the market madness, treasury bonds. And you know what? If inflation comes down and these bond yields plummet, then you can actually probably go to the market and dump these treasury bonds for a profit. Now you're trading bonds, which is really incredible. Now, if you have a longer term horizon, 5+ years, not a bad idea to spread yourself into what I like to do, index funds. I'm the biggest fan of people investing in index funds because of the tax benefits of rebalancing. And I think a lot of folks forget this, but ETFs have a really unique advantage where if an ETF sells a stock that has gone overweight, like let's say Apple's gone overweight and the ETF sells that, they can trade that for a different stock and not pass on as many or potentially any at all capital gains to the individual investor. So if you find an ETF that somebody manages that you really trust, it's actively managed, or you just find a passive ETF, these are great vehicles for making sure you're not getting overweight and you're not getting in certain stocks and you're not experiencing really heavy capital gains events, because those take a lot of money away. Ideally, best case scenario, you find an ETF that you can hold forever and you never have to sell the thing, and then you never have to pay taxes. The inside of the ETF can be traded for different stocks, but you never pay taxes because you're not selling that ETF. Really interesting opportunity in preventing taxation. Of course, again, we talked about tax loss harvesting a little bit. I think there's definitely an opportunity to do that towards the end of the year here. But ETFs are a great tool. Personally, I'm a little bit, I invest a little bit differently, but I think my horizon is 20, 30 years. My risk tolerance is different, and I would never advise what I do personally to anybody else. I'm too heavy in individually chosen stocks, and that comes with a lot of risk, a lot of volatility, and I don't think for folks outside of the financial industry, that's actually even within the financial industry, I don't think that's a good idea for anyone. So, but what I do think is a good idea for almost everyone is after this, getting into real estate. So real estate, I would say we probably have some patience ahead of us. I would likely wait until mortgage rates get back into the 4% range. I think that's going to be a buying signal for the real estate market. And I believe it's critically important that everybody gets started with buying their own home. Now, there are a lot of people who make fun of the idea of buying your own home, and they say, oh, buying your own home is a terrible investment. And they're actually not wrong. It can be. It can be a terrible investment because what a lot of folks do is they buy their own home, and then they remodel it like they're going to live there forever, like it's their forever home, and they waste a lot of money. It's very, very stupid to do that. Spending money on your home is pretty dumb. You should be spending money to fix it up to a rental grade level, and then what my wife and I always, Lauren, what we always told ourselves was, if there's something we didn't end up doing in this home, we just say, next home. We'll just do that on the next home. And then you just hop around. You do something known as bank hacking. The way that works is you borrow 95 to 97% of the property that you're buying, as long as you can afford the payment, substantially afford the payment. Buy something much smaller than what you need. If you're renting a 4-bedroom, 2-bath right now, get yourself a 2-in-1, okay? You and your girlfriend or boyfriend or whatever. And live there for a year, fix it up, and plan to move after a year to a 3-in-1. Move again to a 4-in-2, or 3-in-2, and then a 4-in-2. And keep all of the homes. And make your goal over the next 10 years buying 5 homes. Just move every couple of years. It's not that difficult to do. And if you can do it in a way where your payment is lower, decently lower, $200, $300, $400 lower than what you could get in rent. Now you can cover your expenses for a couple $100 a month for maintenance and repairs, but also for property management. So now you can really focus on building equity. Now, this is what's really important here is that you remember there are 2 phases to life. There is the cash flow phase of life. This is when you're in payoff mode. When you're in payoff mode is when you're getting ready to retire, right? So you're ready to retire and just go cruise around the world, and you just want passive income. You don't care about speculation, you just want passive income. In that phase of life, it makes sense to pay off your mortgages as soon as possible, lower your monthly nut. But for most people watching this channel, I would say 90% of us watching right now, I would focus on maximizing the amount of real estate debt that you can get your hands on. Now, I know that sounds crazy because people hear, oh my gosh, debt, that's so terrible. You don't want to be in debt. Well, the beautiful thing about maximizing real estate debt is these properties, ones that are cash flowing, are being paid for by your tenants. And that means every single month you are doing what's known as passively building wealth through the power of principal pay down. And if you can get a good deal on top of that, you follow the steps in the 0 to Millionaire real estate course, you buy a wedge deal, even better. You get an instant boost to your net worth, which is an incredible opportunity with real estate. Instant boost to your net worth. But you want to be in a situation where every single month your net worth is going up by doing nothing. That is a beautiful thing that you could do with real estate. You do absolutely nothing, your net worth goes up every single month just because your tenants auto pay their rent and you auto pay down the mortgage. So simple. Now, a lot of folks respond to that and say, oh, but Kevin, what if your tenant stops paying rent? Look, this is where you have to be prudent with property management. A lot of people aren't. A lot of people suck at property management. I hate to say it, but I would say most people, 90+% of people just suck at property management. And what I would highly encourage that you do is don't do what most people do. Most people are like, oh, I'll do property management myself and then in the future I'll get a property manager. No. Learn from a property manager first. Get a property manager first. Learn the ways of the industry. Learn about screening folks with credit. Learn about making sure that you're getting quality tenants. And then after you've found that out, after you've learned how property management works, then maybe consider taking over or not. Or just keep a property manager. But screening tenants is the most important thing because they hold a large portion of your net worth. You want to make sure that you're not getting screwed. So this is a long-term perspective, right? My view is very much that as a long-term investor, you want to make sure that at this point, minimize your expenses. Limit those expenses on equipment, on hiring, on monthly fees. educate yourself. So do spend money on yourself, on licenses, certifications, education, and prepare. Increase and secure your income, but also make sure you're ready to get into real estate if you need passive income, treasuries, and diversify in stocks, especially use that ETF hack. Thanks for watching, folks. Check out the links down below. We'll see you next one. Bye.